Warning, 10 minutes presentation followed by 10 minutes. Start when you're ready.
Good afternoon. Thank you for inviting us to share our analysis of Rock 10 with you. My name is Patrick. I'll go over the recommendation and the business description. I'll hand it over to Kathy for the industry. Daniel will go over the financial overview, and Viju will follow up with the valuation. Our recommendation is a hold with a price target of $89. This includes synergies from the Smurfit Stone acquisition, which has led to increasing operating and gross margins. Natural gas projects coming online. Rock 10 is a leader in mill efficiency within the industry, and they also have a proven management team with a history of successful acquisitions. Just to give you a time frame, this recommendation is different than our original report that we submitted on January 17th with a buy rating of $82. On January 23rd, they came out with their first quarter earnings, which revealed that they had realized an additional $50 million in synergies. And the stock has slowly appreciated until yesterday when they hit their 52-week high, $86.50, with only an upside of 2.9% potential. Now to give you an idea of who Rock 10 is, they operate in the corrugated and consumer packaging industry. They're the second largest corrugated manufacturer in the United States. They also operate in consumer packaging and recycle and waste solutions. Now I'll hand it over to Kathy, who will go over the industry.
So the containerboard and corrugated packaging industry is currently in the mature stage. As you can see from this chart, over the past 20 years, there's been increasing concentration within the industry. In the year 2000, the top 4 firms represented about 49% of domestic production. And as you can see, Rock 10 is not one of these top 4 firms. Now in 2012, the top 4 firms represent about 70% of domestic production. And Rock 10 has a 20% market share, the second largest competitor in the industry. We looked at the top economic performance drivers for Rock 10 and other industry competitors, and found that demand is highly driven by the food and beverage manufacturers. 52% of sales in the industry came from that end market, and Rock 10 actually has over 90% of their end market sales are from this food and beverage and also consumer non-durables. Another trend we saw is rising e-commerce demand, and we wanted to point out that we don't think that potential threats from substitutes are very high at this time. Plastic packaging and other packaging materials we don't see as being a big threat to the corrugated packaging industry. Consumer spending and industrial production are expected to increase. These economic indicators have been fairly steady, but we do think that will help drive revenues in the industry. No big moves or large growth rates in either of these areas. Supplier power in the industry is fairly low. The input prices, fuel costs, and raw material costs are very cyclical. But one thing that Rock 10 and other North American industry competitors have done is they've diversified their product mix away from solely relying on recycled virgin fiber, moving towards more virgin fiber. And virgin fiber is known to be less volatile. Finally, pricing power in the industry has been elevated recently. A $50 per ton containerboard price increase has been passed and adopted by all the largest industry competitors. This is primarily due to higher input costs, which, as I mentioned, are cyclical, but it's a good sign for the industry and has really affected their margins. I will now pass it on to Dana to talk about the financial state of Rock 10.
Thank you, Kathy. So as Kathy was mentioning, price increases just were announced for the industry. Rock 10 was one of those who announced the price increase. So for 2013, we're projecting a 3.5% growth for revenues. And then consumer spending, food manufacturing, industrial production, we look at these. As Kathy also mentioned, we see some growth, but we don't think it's substantial. In addition, Rock 10 has a debt capacity that may limit any significant acquisitions going forward. So we don't feel there's going to be huge growth with the company, but we do anticipate about a 2% growth in revenues from 2013 to 2017. And looking at EBITDA by segment, we calculated an 8.8% CAGR from 2013 to 2014. That's mainly comprised of synergies from the Smurfit Stone acquisition as well as natural gas projects. And then we also, thereafter, we had a 3% CAGR and that's based on operating efficiencies. Rock-Tenn is known for their Lean Six Sigma program and creating efficiencies where there are in the market, so we project there's going to be some growth there as well. And looking at our EBITDA margin by segment based on revenue, because of the economy of scale Rock-Tenn now enjoys from the Smurfit Stone acquisition, we believe they'll be able to grow some revenue, some EBITDA through that. They are focused on corrugated segment right now, which is one reason we believe that's going to tick up a bit. While in 2012, the consumer market performed really well, that was based on some favorable input pricing. So we anticipate that's going to go down to about 15%, which is a historical level they've been at. And with that, I'm going to pass it off to Viju, and he's going to tell you about valuation.
Thank you, Daniel. So factoring in all the industrial and financial analysis, we used the DCF, the comparable companies, and the precedent transactions analysis to come up with a valuation for Rock-Tenn. As you can see, the $89 price target falls within the ranges for each of our methodologies. For the comparable companies, we narrowed it down to these 4 competitors based on product scope and size. We eliminated those firms that had a market cap below $3 billion. Now that gives us a mean EV to EBITDA multiple of 8.39, giving us an implied share price of $88.69. For precedent transactions, we identified these 4 companies, these 4 transactions post 2010, as we believed that was a relevant time frame. So that gives us a mean EV to EBITDA multiple of 9.73, giving us an implied share price of $110.12. Now, one thing to keep in mind is that these transactions include a premium. So we did a sensitivity around the premium and the EV to EBITDA multiple. For the DCF model, we made several assumptions for the cash flow drivers. So primarily, we maintained CapEx steady at $350 million, which is actually consistent with historical numbers as a percent of sales. We also included minimum pension payments in excess of pension expense into the model in accordance to management guidelines. And finally, we used a long-term growth rate of 2.5%. We calculated the WACC to be 6.55%, and that gives us an implied share price of $92.62. And finally, for the exit multiple method, we used Rock-Tenn's current EV to EBITDA multiple, which is 8.10, and that gives us an implied share price of $91.51. So with that said, I'll hand it over to Patrick, and he will wrap up the presentation.
Thanks, Viju. We'd like to give you an idea of the risks associated with this investment. Obviously, there's the risk that they won't realize the remaining synergies. For $250 million synergies heading forward, they may not realize those. That could be a risk. Industry-wide factors such as commodity pricing could increase their input costs. And then there's always the risk of potential regulation from the pension requirements. The Pension Act of 2006 dictates what their minimum payments are, and then the EPA could always pass legislation that could affect their cash flow significantly, such as cap and trade. Ultimately, we're confident in our hold recommendations, primarily based on their synergies. They did realize additional $50 million in synergies ahead of schedule in the first quarter. They do have growth potential. It's limited because it's a mature industry, but that they are a major player. They have the economy that's of scale, so their position within the industry, we believe, is stable heading forward. Their debt capacity, as Daniel mentioned, would prevent any kind of major acquisition at this point. They're 3 times debt to EBITDA ratio. They might have a smaller acquisition, but nothing major. So ultimately, we don't see a lot of upside potential, but we do reaffirm our $89 price point. Keep in mind that they're at their 52-week high at $86.50. They've been as low as $49. And just since January, they've realized an appreciation of 23%, and the last 12 months, 30% appreciation. So with that said, we'd like to open it up to questions.
I have one question. You mentioned in talking about input costs that they shifted their mix, if I understood this correctly, to a significantly greater proportion of virgin fiber than recycled. Why is recycled that much more volatile, and why do we think it's going to continue to be that way in the future?
I think that demand from China is a really large factor. Like I mentioned before, global supply and demand is what really drives prices, and China has rapidly increased their production in this industry. And while we don't export a lot, and while sales to them doesn't affect us, that does affect pricing, and currently China uses 100% recycled fiber in their production. So just the fact that we're diversified into two different fibers makes a big difference.
So China is buying all the recycled fiber?
Of their production, they use only recycled fiber, and they make up a very significant portion of that market.
I see.
In your forecast, how important are natural gas prices, and what sort of was your forecast price in terms of natural gas?
Well, can you go to the slide with? So we do anticipate natural gas prices may be increasing some from where they are, but due with fracking and all the new technology that they have and getting this, it's decreasing the supply. So we feel that natural gas prices will stay fairly low or kind of where we're at. We know it's a very volatile industry, but it's hard to predict, and we felt that it would be a good steady state as where it's at today. So that's essentially how we based our natural gas pricing.
Okay. You shouldn't. You had, let me just a couple of questions. You know, I think that your original recommendation was a buy
Yeah.
with a 10% upside. So if I rationalize valuation of $98, I should buy it today?
If you feel it's going to 98.
Well, let's say anybody, if they come out, I mean, is 10% a good margin for me to be a buyer
Really,
with an upside potential of 10%?
Well, I guess it depends on the investor themselves. If they're,
Yeah, but I'm not asking the investor, you're the analyst, I'm asking you. I mean, would that be normal for you to put a buy recommendation on with a potential 10% upside?
yes,
Okay, and how about a downside?
a 10% downside.
Would that be a sell?
Yes.
And you're at a hold.
Yes.
What's the downside on this stock?
we feel that there could be a market correction, especially just a mean reversion, a common market phenomenon, since they have made.
So why should I hold it?
You should hold it today with.
For what reason?
If you
Going
own it,
to
you should
hit-
hold it. If you
We
don't
have
own
our
it,
price target of $89. Based on the synergies, they're going to realize these synergies. It might
So
revert.
from 87 to 89, it's worth holding for that extra buck?
But we think with the mean reversion, we would change our rating to buy. If we see a correction in the market that gives you
All right, I mean, if I own it today, I should hang on to it and let it go down. Is that what you're saying?
long term, we believe it'll hit the $89 valuation, and so you'll.
What's a dollar?
I'm new to the business. If you, at your price target, that would include a 6 or 7, whatever your discount rate is in the return. So even if at the target value, there's a 6% return, so it's looking better than target, you can add it, right? Or is that, am I missing something? Doesn't your target rate include a return of whatever your discounted cash flow rate is?
That's for the. That's for the.
12 months forward, right?
Or whatever their period is, right? They discounted all those things back at some rate, so the current price has that return built in.
Well, we're just looking to make some money, guys. I mean,
Well,
guess what kind of what
as we think about this discount, the value of the stock, the discount rate is obviously very important. Tell us how you arrived at the discount rate that you used. I believe it was somewhere in the 60s, what was your cost of capital there that you used here? Could you tell us how you, oh, there you go.
Yeah, so we use
You don't
the
have to
cost
talk,
of
you can just
debt.
read, right?
Yeah. So the 3.92 is the yield to maturity of the latest bond that they issued. The risk-free rate is the 10-year yield on a treasury.
Why did you use the 10-year?
Oh, just because we just felt that's more appropriate because the timeline is 5 years, so we could find
increased
data
their
for the 10
leverage,
years.
right?
What's
They
that?
increased their leverage during this period over the last 5 years because they did this smurfing, right? So is a 5-year beta the right beta? Would their beta increase given the higher leverage, or is the 5-year beta the right to use, or should it be adjusted for the different capital structure?
There was really only a small difference between the 5 and 10-year beta. We felt the 5-year was most appropriate.
Well, I'm not really saying it's a 5-year the right time frame. I'm asking, should you adjust the beta for the fact that you've got a different amount of degree of leverage now because of the acquisition and you're taking on a debt?
Well, the beta
Did they
is
change?
the beta is just based on their,
Current.
how they act against the market.
Over the last 5 years, but would you project that to be different in the future, given a different degree of leverage?
I think that all the competitors in the industry move in line. We looked at all their stock prices over a recent period, and they're all fairly correlated, although Rock-10 has outperformed. I would say their beta's in line with other betas in the industry, and I know that's dependent on leverage, but we didn't want to change it substantially.
One thing, just a little common sense question. Do you really, really think that a risk-free rate over the next 10 years is 1.85%? Is that logical, or is that because you wrote down the 10-year rate as 1.85%?
We can
I mean,
say-
inflation is running maybe, well, it's been 0, but 2% inflation, so risk-free should imply risk-free and not... I'm just asking you, you're an analyst, you're supposed to answer that. I mean, you know, is it... Would you be happy with 1.85% over the next 10 years?
Obviously not if we put it into a bond, treasury would want 1.8%.
All right, so does that mean it's not risk-free?
Well, it's the risk-free rate that we have right now. I mean,
All right.
that's the way
Yeah,
that's-
just questioning, you know.
And I was interested in your analysis of this company relative to peers, and someone just mentioned that this company has outperformed so many of their peers. In your analysis, how did you factor in differences in financial structure in valuation? So when you looked at their peers, did you make any adjustments for different degrees of leverage, financial stability, any other considerations relative, or did you just simply take the peers as an aggregate, if you will?
Yeah, that's essentially what we did. We just looked at the peers as it is and just applied the multiples.
Okay.
I think you said that much of their business was driven by the food and beverage industry, which is clearly consumer staple, not as economically sensitive. What's driving the higher beta?
I would say a lot of like we mentioned, a lot of their input prices are highly volatile. And so although their end markets are fairly stable and don't change over time, they are very these input prices are related to global supply and demand factors.
So then they're not able to pass on the pricing to their, say, higher input costs, they can't pass those on to their customers, it's going to hit the margin.
So over the past 2 years, they've been able to pass on, or they've not been able to increase prices at all. Only in this year have they been able to pass on prices. And that $50 increase will make a big impact, but it takes a lot for the prices to stick in the industry. And just now they're kind of getting affirmation that those prices will stick, but the markets are highly sensitive to those input costs.
Who is the price fixer in this industry? I mean, who sets the price?
So it works kind of like a game of chicken. So
I mean, what company sets it? Does Rock-10 set its own price, or does it follow IP?
So for example, just recently Georgia Pacific proposed a $50 price increase. It's just whoever of the largest players announces a price increase. If other players
Is there any
follow
problem
along-
with price fixing there? Do you think we got difficulties there?
I don't think there's an issue with collusion or price fixing because in the past there's been instances where
Okay, second, who sets their labor cost?
they want to talk about their mill
They do have
efficiency.
unionized labor, but there hasn't been, they have had 3 work stoppages over the last few years. They all resolved within 2
Does
weeks.
the same union represent Rock-10 as represents Georgia Pacific or whoever your competitors are, International Paper? Are they the same employees? Are they structured like the auto industry where one group will set the price for everybody and everybody has to follow no matter what?
I think it depends on the location of the mill, what union represents that group of employees.
And how much of their cost is labor related?
Do you want to talk about the labor reduction costs?
Well, they have in the last year.
Thank you.